Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TAYLOR MORRISON Home CORP quarterly report. TAYLOR Morrison Home Corporation offers a diverse range of businesses and services, including land development, homebuilding, single and multi-family detached and attached homes, community development, lifestyle and master plan communities, multi-use property development, commercial space, retail, and multifamily properties under the Urban Form brand name, financial services, title insurance, and closing settlement services, build-to-rent homebuilding business under the Yardley brand name. The company operates under several brand names. TAYLOR Morrison, Darling Homes Collection by TAYLOR Morrison, Esplanade, and Yardley. The TAYLOR Morrison Home Corp, TMHC, stock price has dropped by -11.23% in the past year due to several factors. A significant contributor was the third quarter earnings report, which showed a 39% year-over-year decline in future order backlog and a decrease in operating margin from 15.7% to 13%. The second quarter results also raised concerns, with a 12% year-over-year decrease in net sales orders and an increased cancellation rate. Government shutdowns and economic uncertainty further exacerbated investor anxiety, causing a 4.7% drop in the stock. Additionally, negative market reactions to Q2 earnings guidance and declining backlog and revenue projections contributed to the decline. Analysts forecasted revenues projected an 8.2% drop over the subsequent 12 months, reflecting difficulties in adapting to fluctuating demand. A broader shift in sentiment regarding housing market risks and valuation has also contributed to the stock's overall decline, with a 30% year-over-year decrease in the current backlog and a 12% decline in net order activity. These factors have collectively led to a significant drop in TMHC's stock price over the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the increase in home closings revenue, financial services revenue, and amenity and other revenue. Specifically, home closings revenue increased by 1.4% for the 3 months ended September 30, 2025 compared to 2024, while financial services revenue increased by 12.6%. Additionally, land purchase option contracts and land banking agreements also contributed to revenue growth. On the other hand, revenue decline is primarily driven by a decrease in net sales orders, average selling price, and lot premiums, option revenues, and related margins in certain regions. The decline in net sales orders was mainly due to community closeouts, declining sales pace, and increase in cancellations. Furthermore, inventory impairment charges across certain communities also contributed to revenue decline. Neutral factors that affect revenue include seasonality and inflation, which result in quarterly fluctuations in home closings and revenue, as well as higher land, financing, labor, and construction material costs. Net income and profit margins decline. A summary of changes and reasons. The company's financial performance has experienced a decline in both net income and profit margins over the past year. Specifically, net income decreased by $49,685 for the 3 months ended September 30, 2025, and by $32,372 for the 9 months ended September 30, 2025, compared to the same periods in 2024. Profit margins have also declined, with gross margin decreasing from 25% in 2024 to 23.1% in 2025, and net income margin dropping from 11.2% in 2024 to 9.7% in 2025. Home closings gross margin has also decreased from 24.8% for the 3 months ended September 30, 2024, to 22.1% for the same period in 2025. The reasons behind these declines are attributed to several factors, including inventory impairment charges and fair value adjustments for land held for sale, which likely affected net income and profit margins. Additionally, an increase in interest expense, net, and a decrease in home closings gross margin have contributed to the decline in net income. The company's financial performance indicates a strong ability to generate cash from its core operations. With an operating cash flow of $170.9 million for the 9 months ended September 30, 2025, it is clear that the business is producing sufficient funds to cover its expenses and invest in growth initiatives. This positive trend suggests a stable and profitable financial foundation for the company. The company's debt level and interest expenses have undergone significant changes. while the total liabilities increased by a mere 0.6%. Loans payable and other borrowings saw a substantial rise of 19.7%. However, the overall total debt decreased by $75,576. On the other hand, interest expenses skyrocketed from $3,379 in 2024 to $12,774 in 2025, indicating a significant increase. This suggests that despite some fluctuations, the company's financial obligations have become more burdensome, with higher interest expenses weighing on its bottom line. Management is optimistic about the company's outlook, citing adequate capital resources to sustain operations for the next 12 months. They expect to generate sufficient cash from operations, but may also access capital markets for additional liquidity. In the long term, the focus will be on paying off debt and repurchasing common stock. The company's business strategy is centered around driving growth through market expansion and operational efficiency improvements. Management believes that strategic initiatives will increase revenue and profitability, delivering long-term value to shareholders. Despite current market conditions, including elevated mortgage interest rates and seasonality, the company remains committed to offering incentives and discounts to drive sales. The company's financial activities involve both acquisitions and divestitures. In terms of acquisitions, it is worth noting that while no explicit acquisitions are mentioned, the company did enter into land purchase option contracts and land banking agreements with a total value of $3 billion. On the other hand, the company engaged in several divestitures, including the sale of one urban form asset in California for $22.8 million during the 3 months ended September 30, 2025. The company has indeed engaged in share buybacks. Specifically, between July and September 2025, the company purchased a total of 1,277,533,000 shares. This includes repurchasing 142,429 shares with ASRs and 1,135,104 shares under other share repurchases. Concerns about inventory buildup and supply chain disruption are evident in the financial summary. The increase in real estate held for development or sale by $5,172 from December 31, 2024 to September 30, 2025 suggests a potential accumulation of unsold properties. Additionally, sales order cancellations increased during the same period, indicating a possible mismatch between supply and demand. The significant cash outflows prior to recognition of earnings due to inventory costs further highlight the issue. Inventory impairment charges of $25 million for the 3 months and $28.8 million for the 9 months ended September 30, 2025, also indicate that the company is struggling with excess inventory. These factors collectively suggest concerns about inventory buildup and potential supply chain disruptions. That concludes the financial summary for TAYLOR MORRISON Home CORP. Feel free to comment below, and I will be happy to answer them when possible.